Good morning and welcome to Financial Accounting. As we start our day with the calendar, as we always do, you can see because we finished Chapter 5 on Monday, the Chapter 5 problem should be submitted for grading before midnight tonight, ideally. We did a brief intro to Chapter 6 on Monday, but we will start Chapter 6 in earnest today. So the Chapter 6 pre-quiz should be submitted for grading before the end of the day. We'll finish Chapter 6 on Monday, and so the exercises would be due on Monday. And then on Wednesday, the Chapter 6 problem would be due. Wednesday is also when our 6-week grades are due. So today's actually the last day of week 6 of class. And so next Wednesday, the 9th of March, is when 6-week grades are due. I think I mentioned those in an earlier class, but in case you didn't hear that, in case you're new to JCC, at the end of 6 weeks each semester, we as faculty are required to report on how our students are doing. And so for this class, your grade will consist of everything that was due prior to March 9th. So that would be through the Chapter 6 exercises. And if you've submitted anything else beyond that, that would also be included as well. So if you did have the Chapter 6 problem submitted, and before I bring the grades over from Cengage, then that would also be included. As I've said in an earlier announcement, anything that's already due, if you haven't submitted it for grading, I will enter a 0 into the grade book temporarily, and that 0 will be averaged into your grade so that your 6-week grade is an actual reflection of here's where you stand in this class right now. If the semester were to end that day, that's what your grade would be. So whatever your grade shows in Blackboard will also for this class be what shows in Banner, which is where we submit those grades. So if you have anything that you've been working on and you're done working on it but haven't submitted it for grading, then please make sure you get that submitted so that you don't have a 0 showing up in the Blackboard grade book for something that you maybe already have an 80% or something. I don't bring the grades over from CNOW until you've actually submitted them, because otherwise those grades can continue to change if you continue to work on that, and I would have no way of knowing that. So they need to be submitted for grading in order to count toward your 6-week grade. My plan, my expectation is also that the project ones will be done by the end of this week. I have been working on them, but I am making them a priority now to make sure that those grades are in so that they're included in your 6-week grade. For most people, those grades do end up bringing your grade up, giving a little bit of a bump to your average. And so I want them in for that reason, but it's also important that you have that feedback because as you can see, looking ahead, in less than 2 weeks, the second part of the project is due. So you really need to have the feedback on the first part of the project to know maybe what you did wrong. Even though the second project is totally different, there are some things that you may learn from your mistakes maybe on the first project. So before we jump into Chapter 6 today, does anyone have any questions about Chapter 5 or anything else that we have talked about up to this point? Okay. Then we will jump right into, I'm going to make this full screen like that so it gives me a little bit of space for writing. We're going to jump right into our exercises then for Chapter 6. So I'll give you just a moment while I review what we talked about last class. In Chapter 5, we introduced the idea of perpetual versus periodic inventory systems. And we said the difference between those two systems is how often you update the inventory record. A perpetual inventory system updates that record every time there's a change to your inventory. You make a purchase, you make a sale, you accept a return, and add that back to inventory. We make those adjustments in the inventory account every time they happen. You can see in this exercise, we're going to be starting with the perpetual inventory system. And I explained in our Chapter 5 coverage that that's because most companies do use a perpetual inventory system now. As we go through these exercises, though, you'll see that it gets a little bit tedious. It's very labor intensive when we have to do it manually as opposed to having the computer do the work for us. So most companies, if they're using a perpetual inventory system, they're using some kind of a scanning type system. So think about a grocery store. As you scan each one of the groceries, it knows exactly what you purchased, or at least what product it is. You bought the 12-ounce Kellogg's Corn Flakes and so on. And so it takes the intensive labor part out of it. As we go through these, you'll probably be a little bit annoyed at the work that's involved when we are doing it by hand like this. And you'll at least get a sense of what the computer is doing for us in the background. Of course, we're looking at summary. We are looking at companies that are selling only one product, which is also not terribly realistic. So you can, again, imagine if this was a realistic scenario where you've got a grocery store that sells tens of thousands of products, how incredibly important it is that the computer's doing that work for us rather than us trying to do that. And you'll also get a real feel for why companies prior to the advent of computers and the affordable nature of where the Scantron systems are now. You'll understand why companies like the Dollar Tree that I know I talked about last week, why they did not use a perpetual system until fairly recently. They used a periodic inventory system and they just rang up, oh, you bought 10 things at $1, that's $10 or $10 plus tax. Okay, so what we're going to be doing today, as I said, is starting with the perpetual inventory system. And last class, I briefly described for you the 3 different methods, the valuation methods that we're going to be using. In these exercises, then, we're going to be going through each of those 3 methods and then comparing the results that we get for those 3 methods. We'll be doing that for a perpetual system, and then we'll be doing it for the periodic system. So this will carry over to Monday's class as well. So you can see here in our first exercise, we're starting with a perpetual system and the FIFO, first in, first out. You can see that right up here. We're going to be using the FIFO method. So as I described it on Monday, the FIFO method, first in, first out, means when we make a sale, we assume we sold the oldest products first. For some businesses, we hope that's what's actually happening. So think about if you're a grocery store, if somebody's buying a gallon of milk, you hope they're buying the oldest gallon of milk, and then we're keeping the newest ones. There definitely are people who go in and they're looking at the dates and they're going to reach behind and grab the one that has a newer date on it. I will confess I do that myself. But what I told you on Monday is it does not matter for what we are doing here, whether they actually sell the oldest one first. Because what we are looking at is the flow of cost through our accounting records, through the inventory record. It may match what's happening in the store. If we are a grocery store, we hope it matches what's happening in the store. But from an accounting perspective, it doesn't matter whether it actually matches. So we think of this, if you're a computer guy, you may be familiar with the idea of stacks versus queues as you are doing programming stuff. So this is like the queue. And I should put that on the screen to make sure you understand the word that I'm saying. Q-U-E. So a queue, if you may, if you have contact with people who are or European. Europeans, where we say we're standing in line, Europeans would say they're standing on queue. And what it means is exactly what I just described. I can't draw it. Oh, maybe I can. I get a little, there we go. Okay, so what this means is we put the new stuff in the back, and it just keeps moving through the line, through that queue, and when we sell it, it comes out of the front. And so these are the items that have been in line or on queue the longest. And when we buy new inventory, it just gets at the back of the line. And when we sell, we take it off the front of the line. You take the next one up. It may not be that way in the actual store or in the actual selling location. But for our accounting records, this is what we are assuming happens. We sell the oldest stuff first, and we keep the newest stuff. First in, that's the first stuff we bought, first stuff in line is the first stuff out the door, the first stuff to go.
Roller coaster queue.
What's that?
Roller coaster.
Yeah, yep. Just like any line or queue that you would think of. Yeah. Okay, so that's what we're going to be looking at here. And we are asked to determine the cost of goods sold for each sale, the inventory balance after each sale. And we're going to be using this worksheet here, which is an inventory record or cost of goods sold schedule of everything that happened during the month of November. I am going to just leave this right here because I have a printout of what's at the top of the screen. So I will be able to leave that, and I'll be able to maybe write on the screen if I need to over here to show you any calculations. You, of course, may need to scroll up to where that table is at the top of the screen. This is the information that we're going to be using to fill out this inventory record. I want to point out for the perpetual system, it is important that we have these transactions, excuse me, in chronological order. That is the order in which they occurred throughout the period that we are accounting for. You will see when we get to the periodic system, it doesn't matter the actual order that things happened. We're accounting for everything that happened during the period all at one time at the end of that period. But for the perpetual system, because we update our inventory record after each transaction, we need to make sure that we are doing them in the proper order. That is the order that they actually occurred during the period. Whoops. Get that right there. And we will start with November 1st. So at the beginning of the month, they had 120 units available. So these three sets of columns, you'll notice that the columns kind of can be grouped together. Let's see what color I want to use. Grouped together in threes. So those first three columns are for purchases. The second three columns are for sales. And then the final three columns is our inventory balance. So at the beginning of the month, we had 120 units available for sale, and each of those units had a cost, so what we paid for it, of $120. Sorry, 120 units at $39. 120 units at $39. The extension is units times unit price, $46.80. So we know how many units we had, we know the price we paid for them, and we know the total value of our inventory at the beginning of the month. Now we're going to go through these transactions chronologically. the first thing that happened was November 10th, we sold 90 units. So those middle three columns are for sales. We sold 90 units. What's important for our inventory record is not how much we charged our customers. So there would be a separate entry for that revenue. And we've seen that through chapter 5 when we looked at all those transactions for purchases and sales. We saw that when we use a perpetual inventory system, we record the revenue, but we also have to record the cost of goods sold, the reduction in our inventory. Right here, we're only looking at the inventory account. And so we don't see the revenue. It doesn't even tell us how much we charged our customers, something more than $39 for sure, but we don't know that. And we don't need to know for the inventory record. We would certainly need to know for recording the revenue, but that's a separate transaction that needs to be recorded. So when we sold these units, we had only one price. $39 was the price of the units that we had on hand. So it must be that the ones we sold had a price of $39. As we move through this example, I'm just putting in the extension, 90 times 39 is 3510. As we move through this example, you'll see that as prices change, as our costs change, we will have DVD players, what we're accounting for here. We will have DVD players that cost $39, but we'll also have DVD players that cost $40 and $43 looking at what's given. Right now we have just that one price. So we didn't have to decide which ones did we sell because we have only one option, $39 ones. If we had 120 units before and we sold 90 of them, how many do we have left? Thank you. And they must be worth $39 each. That's our cost because it's the only choice we have right now. And so somebody looked at that and said, ooh, we only have 30 DVD players left. We better order some more. I talked about in chapter 5 that maybe we have an automatic order point, the importance of balancing our inventory, that art of having enough to meet customer demand, but not so much that we have a lot of our working capital tied up in inventory. We talked about operating cycle and financing period. So this company may have an automatic trigger or order point, set point. It gets down to below 40 and we automatically order them. It may be that someone is manually looking at this and says, ooh, 30, we better order some more. Either way, we can see that on November 15th, they did purchase 140 additional units at a price of $40 each. Putting in the extension, that's $5,600. So what do we have now? Well, we still have the 30 DVD players that we already had. We still have those at $39 each, but we also now have the 140 units at $40 each. So our total inventory now is 170 units. 30 of them are the older units at $39 each. The rest are the newer units at $40 each. So when we have another sale, as we're going to see next, because we're using the FIFO method, the first thing we're going to do is sell those $39 ones. They were the first in line. We're going to sell those first. And then we will start selling the $40 ones. Everybody with me so far? So moving ahead then, on November 20th, we had another sale and we sold 110 units. Don't follow me yet. We sold 110 units. But I just explained that the first units we would sell would be the $39 ones. We can't say we sold 110 $39 DVD players because we didn't have 110 of those left. We only had 30 of those. So we're going to sell those 30 first because they were the first in line. Then we're going to make up the rest of the sale. So if we sold 110 total and 30 were the $39 ones, it must be that 80 were the $40 ones, right? We have to sell the oldest ones first, the $39 ones first, but we can't sell all $39 ones because we didn't have enough of them. So once we sell the $39 ones, then we make up the difference. 110 total, 30 were $39. The other 80 must have been $40 ones. So now as we look at these inventory layers we had here, we sold off the $39 ones. We sold 80 of the $140 players. So if we sold 80 of those 140, how many do we have left? 60, right? So we're going to keep 60 of the $40 ones. We've now gotten rid of the first ones in line, those $39 ones. Now we have another sale. On November 24th, we sell an additional 45. We didn't order any more in between there because somebody was looking at that 60 saying, oh, that's enough. And I think in my example, I said the trigger point or the set point might be 40. And so we get below 40, we automatically order some maybe. But we haven't ordered any more yet. So on November 24th, we sell 45 more. At this point, we only have DVDs with players with one price, and that is the $40 price. With the extension, that's $1,800. So we had 60 of those left before this sale, but we just sold 45, so we now have 15. The only option is the $40 price. So we now have only $600 worth of inventory left. We have 15 units, so we better order some more. And on November 30th, we order and receive an additional 160 units, and now the price is $43. So we are in a period of rising prices here. We are in a period of rising prices. Hi, Maddie. Hi. So we're in a period of rising prices. The price went from 39 at the beginning of the month to 40 to 43. We still need to construct these layers as we update the ending balance in our inventory. We need to keep these separate and we need to keep them in order. It's important that we know which ones are the oldest ones and which ones are the newest ones, so that we report as sold the appropriate ones. And under FIFO, the ones we sell again is the oldest ones. So now looking at our final line, this is the end of the month, and so we need to update our balances. This balance is going to be for the cost of goods sold, and we've had 4 separate sales, so we need to add those together. So we're adding down that column, the 4 sales, the value or the cost of that inventory. And the total value of our inventory. Remember to add the 2, we have 2 layers. We have the $40 and the $43 ones. So we need to add those together to get the total value of our inventory. $74.80. So that's how we complete the inventory record. You can see how obnoxious it is, right? You have to do all those by hand calculations. Now imagine that each one of those DVDs, DVD players was sold separately, and we had to make an entry for every one, we'd still be back on November 10th because we'd have to record each one of those 90 ones that we sold separately. At least here we're doing it for just one product, and we're doing it in groups. We sold 90 altogether. So we're doing kind of summary entries. It would not be possible to do this without the assistance of a computer. Okay, so let me pose a question to you. As I already pointed out, we are in a period of rising prices. Our supplier at the beginning of the month, or at the end of last month, was charging us $39 for each one of these units. Then the price was $40, and then it was $43. Do you think that the price our supplier charges us has anything to do with whether we use LIFO or FIFO or average cost? In other words, did our supplier say, how much are we going to charge you? I don't know. How do you value your inventory? Do you think they know or care that we are using FIFO? No. The answer is no. How much we pay for the inventory is the same. 39, 40, 43 is totally unrelated to which inventory valuation method we choose to use, or even whether we use a perpetual or periodic system. Our suppliers don't care how we value it. What they set their price based on their cost. How about how much we charge our customers? So I pointed out we had these 4 sales. We don't know how much we charged our customers, but let's just pretend we charge them, I don't know, $100 per DVD player. Do you think that if we use LIFO, we would charge them a different price than if we used FIFO or average cost? No. No more than our suppliers change their price based on what system or method we use. So how much we charge our customers is not related to which inventory valuation method we use. How much we pay our suppliers is not related to that. So why do we have these 3 methods that we're using? And there is a 4th one that's known as specific identification. So we aren't really looking at that one because specific identification is actually different than the other 3. Specific identification means you know exactly which unit you sold. And when you report it, you report the exact unit you sold. We don't make this assumption about the flow of costs. We sold the oldest. No, we sold the newest. We don't do that under specific identification. So that's the hardest one to implement because we have to know exactly which unit we sold. So think about it. If you're a grocery store and you're selling 12-ounce boxes of Kellogg's Corn Flakes, you need to know you sold the 12-ounce box of Kellogg's Corn Flakes, but do you need to know it's the one that went on the shelf on Tuesday compared to last Friday? No, they're all the same. Imagine if you had to keep track of that. Oh, wait, which batch was that from? That would make this an incredible nightmare. You know, the barcodes are specific to the product, but not to the date on the product.
What would that be used for?
Good question. So why would you go through all that extra work of knowing exactly which product? How about if every single product you sell is different? So think about a car dealership. It's not enough for the car dealership to know, oh, we just sold the 2021 Ford Explorer, because they might have 7 of them on their lot. So they need to know it was the red one with this package and those options, because every one of them is a different price. Or if you are anything that's a custom job, you know, if you're selling houses, you need to know which house you sold, right? If you are selling artwork, you need to know which piece of artwork you sold because everyone is different. If you're selling antiques, you need to know which one did you sell because they're all different. You don't have 17 or 2,700 of exactly the same thing sitting on the shelf. Does that make sense? Yeah. So we're not really, although I'm mentioning specific identification, we're not really going over it in this chapter because it is a different assumption. It's a different working set of knowledge to use that. And it is easier in one respect because we don't have to make an assumption about which one we sold. but it's harder because we have to know exactly which one. And whichever one we sold is what we say we sold. Other than that, for these three methods, LIFO, FIFO, and average cost, we must know exactly, we must know what the assumption is about which one we sold. And so here we are in our period of rising prices, 39, 40, and 43. We already said how much we pay our supplier, how much we charge our customers is independent, unrelated to which system and method we use. So what that means is, if we think about, let me just put this on the screen. Last class I had, I think, maybe not, I think I had talked about this, but if so, it will be review. If not, then we've covered this in chapter 5 anyway. So if we start with our sales, so this is kind of the format of the income statement. Sales minus cost of goods sold equals gross margin or gross profit. But now we are learning, how do we calculate this cost of goods sold piece? And here's how we do that. We start with our beginning inventory. We add to that our purchases. And we subtract from that our, well, that gives us, let me put an intermediate step here. Beginning inventory plus purchases tells us how much we had available for sale. We then have to count our ending inventory. We do that physical inventory. And if we subtract our ending inventory, we get cost of goods sold. So that, the piece that I just put here, these 5 lines, are the calculation for our cost of goods sold. That's not how we did it here, but there's one piece that's missing in this, and that is the concept of inventory shrinkage. So what we have here in this record where we end with 15 of the $40 case DVD players and 160 of the $43 DVD players, we have not actually physically gone out and counted our inventory to see if we truly have 175 units left. And based on what we talked about in chapter 5, if we did have fewer units left, we would count that as part of cost of goods sold, because it's a part of the cost of doing business. We don't have that inventory anymore. We have to assume it's been sold. It becomes part of cost of goods sold. That's why this relationship is important, that we have an actual count for ending inventory and we back into, or we calculate our cost of goods sold. We don't just go, even when we use a perpetual system, this 9680 right here is what our cost of goods sold account is showing at the end of the month before we do adjustments. But then we would go out and count, oops, can't do it that way. Then we would go out and count, do we actually have these 15 and this 160? Do we actually have 175 units left? And if we don't, if we have 172, let's say, yes, we're concerned about where did those other 3 go, but in the meantime, they become part of the cost of goods sold. So back to what I said here. Here's our outline of how to calculate that cost of goods sold. Well, in this example, the beginning inventory was 120 units at $39. That would be our beginning inventory in this exercise, whether we use LIFO, FIFO, average cost. The purchases, we already said, are exactly the same regardless of which method and system we use. So if the beginning inventory is the same and the purchases are same, then the goods available for sale are also the same, regardless of which method and system we're using. Under the three methods, and I said two because this question in part B specifically references last in, first out, the opposite of first in, first out. So if our goods available for sale are the same, but our ending inventories are different, then the cost of goods sold would also be different because math, right? Goods available for sale minus ending inventory equals cost of goods sold. If the goods available for sale is the same under the two methods, then the ending inventory is different. Cost of goods sold would also be different. The question we're asked here is, well, would it be higher or lower? The first thing to point out is which method we use does not affect the quantity of DVD players we have available. So here in this exercise, at the end of November, we have a total of 175 units in our ending inventory. That's true whether we use FIFO, LIFO, average cost, or specific identification. We have the same number of units. What differs, what changes, is how much we say they're worth. Is everyone clear on that? The physical count, 175 units, is the same. What's different is how much we say they're worth. So under FIFO, we sold the oldest ones, which in a period of rising prices are the cheapest ones. We sold the $39 ones. We sold most of the $40 ones. And the ending inventory includes the highest value ones, a few $40 ones and mostly $43 ones. Under LIFO, last in, first out, we sell the newest ones. We sell the newest ones. The newest ones are going to have the higher prices, and our ending inventory is going to have the lower prices. We're going to keep the $39 ones. And so, based on these data, would you expect the inventory to be higher or lower using the last in, first out? The inventory would be lower because we kept the $39 ones, not the $43 ones.
So what would you do with the rest? Keep them in like the back or whatever? Or
So
do you
the
sell
number
them-
of units you have is
Yeah.
the same. So you still have the same 175 units. What's different is how you split up. So
you'd be getting more money though.
So if I understand what you're asking, let me just walk you through the scenario. So let me use my calculator here for a second. I'll put this on the screen so everybody can see it. Okay, so in this month, in the month of November, the goods available for sale for this company, the DVD players that we had a total value of $17,160. You can check my math if you want. Where did that come from? It's what we started with, the 4680 plus the two purchases, 5600 and 6880. Okay. We had a total of $17,160 worth of merchandise available throughout the month. Not all at the same time, but at some point during the month, in total, that's what we had available. Everyone okay with that number? Okay. So that's this number right here. Goods available for sale. Under FIFO, we decided what did we keep and what did we sell. We took that $17,160 and we said, of that $17,160, about $9,700 of it was sold, and just rounding off, $7,500 of it we kept. Under LIFO then, we already said the ending inventory would be lower. It would be something less than this $7,500. What that means is the cost of goods sold would be something more. because we have to account for that total of $17,160. It's either been sold or we still have it. So if we're saying we have less left, then we must be saying we sold more. In a period of rising prices, FIFO results in a higher ending inventory and a lower cost of goods sold. LIFO has a lower ending inventory and a higher cost of goods sold. Which one of those looks better on our financial statements? Keep in mind, cost of goods sold is an expense. It shows up on our income statement. Do we look more successful, more profitable as a company if we have more expense or less expense? Less. So FIFO makes us, in a period of rising prices, FIFO makes us look better on the income statement because we have lower expenses and therefore a higher income at the end of the period. How about on the balance sheet? Inventory is an asset on the balance sheet. Do we look better if we have more assets or less? More, right? We'd rather have more stuff, right? We'd rather show that our company has a bigger value. So FIFO also makes us look better in a period of rising prices. FIFO also makes us look better on the balance sheet because our assets are higher. Assets are higher, income is higher. Both of those things make our company look better. So in a period of rising prices, just based on that, it seems as if companies would just use FIFO. And then if prices start falling, maybe they switch over to LIFO, because what I just described, the reason I'm careful to say each time in a period of rising prices, if prices are falling, that relationship is flipped completely on its head. Because if prices are falling, the higher priced ones are the older ones, and LIFO is going to say that we're keeping those, and FIFO is going to say we're selling those higher prices. So in a period of falling prices, if that were to happen, then we'd see exactly that opposite relationship. LIFO looks better, FIFO looks worse. But most of the time, to be honest, we're in a period of rising prices. And so FIFO makes us look better. So why would a company ever use anything other than FIFO if it makes us look better? Need to restate, we're not actually better in most circumstances. We still have the same 175 units. We have the same amount of merchandise. We're just saying it has a higher value. So we still have those same number of units. We already said it doesn't affect how much we charge our customers. Our revenues stay the same. Doesn't affect how much we pay our suppliers. So our cost, our actual cash flow is the same as far as paying for that inventory. So where does LIFO help us? In a period of rising prices, if we use LIFO, we report lower income. Lower income equals lower income tax, right? Yes. Lower income means lower income tax. Would a business like to pay less in taxes? Yeah, so would I. So LIFO helps us in tax, and that is actually a cash flow difference. I already pointed out, it doesn't affect our revenues. It doesn't affect our costs at what we pay our supplier. But what it does affect in a real way is our income tax. And so that's why companies will use LIFO. So the next question is, okay, but you've told us before that sometimes tax accounting is different than financial accounting that we're doing here. So why wouldn't they just use LIFO for their tax and then use FIFO for their financial statements, and then they have their cake and eat it too, as the saying goes? I, for one, today is Ash Wednesday. I won't be eating any cake, but how do they get away with that? Why don't they just use LIFO on their taxes and FIFO on their financial statements? Because this is one place, very interestingly. Normally the IRS just kind of stays out of it. You do you, let me do me. We'll tell you what the tax rules are. You have to follow the tax rules for your tax forms, but you can do whatever you want on your financial statements. But this is one place where the IRS has actually stepped in and said, you know what? You can go ahead and use LIFO and save money on your taxes. But if you use LIFO for your taxes, you are also required to use LIFO on your financial statements. One place where they intervened and said, you have to do it. You're gonna do it here, you're gonna do it here. You can't have your cake and eat it too. And so companies don't use FIFO on their the companies that choose to use LIFO do it because it saves them money on their taxes, and they're willing to take the hit on their financial statements because the cash flow difference is the taxes. Okay. That's enough of this exercise. Does anyone have any questions at this point? So you may want to make a note of this formula right here. I think it might even be in the reference materials for this chapter, but that's going to be an important relationship, and we'll keep coming back to that. So I'll leave it there just for a second in case anyone needs to make a note of it. But it might be in your reference materials. Possible. Okay, so let me clear my drawings here. We'll get our green check marks in there. And we will keep going. So that is the FIFO method under the perpetual inventory system. What we are going to do now is look at the LIFO method. Same information, same company, but what would it look like if they used LIFO? Give me just a moment here. Okay, so as we look ahead at these exercises, exercise 5, you'll notice the heading, perpetual inventory using FIFO. That's exactly what we just did. So exercise 5 is going to be something for you to try at home or outside of class. The form is identical in format to what we just used. So you've got the 3 columns for purchases, 3 columns for sales, and 3 columns for the ending inventory or the inventory totals. So please make a note, exercise 5. If we had time on Monday, we would be able to go over this in class. And of course, I'll be happy to answer any questions you have about it. But in general, we probably will not have time in class to go over this whole exercise. So make a note, please try exercise 5 on your own. We're going to move ahead then to exercise 2, which, as I already mentioned, is the same information, same company. They're still using a perpetual inventory system, but they use the LIFO, or last in, first out method. Let me make this a little bigger again. So, oops, so we can see the whole thing. And so we already speculated in the previous exercise, and our answer was right, to the second part of part B, that under LIFO, our ending inventory would be lower and our cost of goods sold would be higher. When we finish this exercise, you will see, we can compare this back to the previous exercise and see that, yes, same company, same sales, same purchases, same pricing that we pay our suppliers, and we have that same $17,160 of goods available for sale, but the split, how much we say we sold and how much we say we kept, is going to be different. So let's go ahead to that, get started with that. Find my note here. So we started with 120 units at $39 each. Total of $4,680 in our beginning inventory. That looks exactly the same. We have our first sale of 90 units. Again, we only have the $39 ones. So those are the ones we will need to say that, we will need to say that we sold. And the ones we keep must be the $39 ones because those are the only ones we have. So far, so good. Nothing changed between the FIFO and the LIFO methods because we only had that one price for our inventory. Now we make a purchase. 140 units at $40. Total of $5,600. And we're going to set up those same layers. The $39 ones are listed first because those are the oldest, followed by the $40 ones, the newer ones that we have. Again, if you compare what we did here to what we did in the previous exercise, everything's the same so far. If our prices never changed, there would not be a need for different ways of different assumptions about the flow of our costs. So in a period where prices are pretty stable, you would see the same results for two companies doing exactly the same thing, but using different systems and methods. They'd look pretty much the same. Where you get to see the larger differences is when, as companies have been around for a long, long time, they've formed what are known as these LIFO layers. And so the price that they're carrying their inventory for a product that they've sold for 100 years, the prices that they're carrying are still those really old prices, and they're going to be super low. What happens next? On November 20th, we had a sale of 110 units. Here's where we're going to see our first difference in this exercise compared to the first one. Under LIFO, the last ones in, the newest ones, are the first ones to go, are the ones that we sold. So our newest units are these 140 units at $40. We had a sale of 110, and we're going to say we sold not the $39 ones like we did under FIFO, but we're going to say all the units we sold were worth $40. And so our cost of goods sold is already higher than it was under FIFO because we're selling the newest and therefore the more expensive units. So we still have those $39 ones. We sold 110 of the $40 ones, and so we have 30 of those left. We had 140 at $40. We sold 110. We have 30 left. Everybody good so far? Okay. What happened next? On November 24th, we had another sale. We sold 45 units. We don't have 45 of the newer ones left. So we're going to sell all 30 of those. And then we have to sell 15 of the $39 ones. And so what do we have left? Just 15 of the $39 ones. So at this point, we have eaten into that lowest layer, the oldest layer. When this happens at an extreme level, when a company has those really old, really low valued LIFO layers, and they eat into them like we just did by selling some of those $39 ones, remember, we can't get those back. Okay. You can't restore that layer. We can't pretend we have more of the $39 ones when the price is now $43. That is referred to as a LIFO liquidation, and it has an extreme impact on their income because they're showing super low cost and therefore a much higher than expected income, which it greatly impacts their income tax. LIFO liquidation is a bad thing from a company's perspective. What happens next? Last thing that happens, we only have 15 units left, so we need to make a purchase. That purchase is exactly the same. It's $43. That's what our supplier is charging us. It has no relation to, oops. Has no relation to what system or method that we choose to use. And so at the very end, we are going to set up our remaining layers. We still have 15 of those $39 ones, plus we have all of the higher priced $43 ones. So the ending balance for our inventory, we need to add the two layers together. And the ending balance for our cost of goods sold, add up the cost from each of the 4 sales. And now if you were to compare those numbers back to the previous exercise, you'll see that our cost of goods sold is just a little bit higher and our inventory is just a little bit lower. The reason there's not more of a dramatic difference between those two exercises is because we ended up selling off most of those older units. If I were working for this company and trying to manage our LIFO liquidation that I described, I would have suggested that this 160 unit purchase at the $43 happened maybe even back here before they sold off, certainly here after the 20th, before they started selling off those older units. We don't really want to sell the $39 ones and eat into those layers. So again, you start to see a little bit of a change as time goes on, as the LIFO using company keeps the $39 ones and the company that uses FIFO starts carrying them at higher and higher prices, you'll start to see an even more dramatic difference between what we see here for this company and what we saw in the first exercise when they used FIFO. So if you look ahead to exercise 6, again, I will be glad to do these together as a class if we have time, but we're going to go through each of the different scenarios, perpetual, all 3 methods, periodic, all 3 methods, before we come back to the extra practice ones. So you may want to try exercise 6 on your own at home between now and Monday, but we will, if we have time, we'll come back and work on that together. And let's move on to exercise 3. I need to make this a little smaller so it's going to fit on the screen. There we go. Is everybody still able to see that if it's that small? Because when they put in this whole chart thing, it obviously made it a little bit bigger. And I want the whole thing to fit on the screen rather than scrolling back and forth. So exercise 3, we are still using a perpetual inventory system. And we are looking at the third assumption about cost flow. So we've done FIFO, we've done LIFO, now we're going to look at the weighted average. The weighted average method is probably simpler than the other 2. As I mentioned on Monday, the results of the weighted average method fall somewhere between LIFO and FIFO. So those are the 2 extremes. In a period of rising or in a period of falling prices, weighted average is going to fall somewhere between the 2 extremes. One of the advantages of the weighted average cost method is we only ever carry our inventory at any given point we say that our inventory all has the same value. We don't have to keep those separate layers. So like we saw in the last two exercises, we're not going to have the 39 and the 40, or the 40 and the $43 ones, or the 39 and the $43 ones at the same time. Each time we make a purchase, we're going to recalculate the average cost of what we have. And then we'll use that for all of our units. So it is easier in that respect. It is a weighted average. So some of you may have taken or might currently be taking statistics. In statistics, you learn how to do a weighted average, but it's not complicated math, and I'm going to show you how to do it. What you need to keep in mind is we do not just average together the prices. So you can see in this exercise, we have prices of 75, 77.50, and 80.25. We're not just going to take the 75 and the 77.50 and average it together. We're not just going to take the 77.50 and the 80.25 and average them together. We have to apply the weights based on the number of units we have at each price. Again, I'll show you how to do that. I'll give you the formula for doing that. So let's get started. We're using a perpetual system, so every time we have a purchase or sale, we need to update our records. And as I told you, every time we have a purchase, the update includes finding the new average price. So we start the month with 10,000 units with an average price of $75 each. So the total value of our inventory at the beginning of the month was $750,000. Okay. On March 18th, we had our first sale and we sold 8,000 units. As we pointed out with the last two exercises, we don't know how much we charged our customers for this exercise. Of course, if we worked for the company, we would know that. We only have one price, $75. So all 8,000 units must have that same price of $75 per unit, a total of $600,000. We had 10,000 units, we sold 8,000. How many do we have left? 2,000. And as I already pointed out, under weighted average, we only ever have one price for the product. Right now, that price is $75. Everybody good so far? Okay. Now I said when we make a purchase, we're going to have to find a new average price. So we add that cost to our record, 18,000 units at $77.50 is a total of $1,395,000. Oops, I'm going to put on the screen how to find that weighted average price. We need to add, no, I wouldn't take my second D. We need to add together the costs. And I think I'll just put the example here. So our beginning inventory, our inventory at that time of the purchase was $150,000. We can see that at the end of March 18th. And then we add to that the purchase price of the new stuff. So that's the total value of our inventory right now. Total value is $1,545,000. And I'm just going to enter that here. The total value of our inventory is $1,545,000. It's the $150,000 we already had, plus the new purchase, $1,395,000. Step 2 is to find the total units. So that's going to be the inventory we already had, which was 2,000 units, plus what we just purchased, 18,000 units. So we have a total now of 20,000 units. Okay, nothing magical there. We just found the total cost, the total value of our inventory, and the total number of units. Now, excuse me, we're going to find the average. I know this is running a little bit into my table here, but I don't know, maybe I can move this over here. One way or the other, I'm going to run over something, I guess. So we take the total cost, $1,545,000, and we divide by the total number of units. Hopefully that doesn't run too much into the other stuff. So we take the total cost and divide by the total number of units, and that gives us our average cost per unit. We did not just take the 75 and the 77.50 and average them together. Why not? Because we only had 2,000 at $75. We had 18,000 at $77.50. So the average price, the weighted average, is going to be closer to the $77.50 because we had 9 times as many units at that price. Everybody okay with the steps we followed to find that average? Just make sure you're not averaging the prices together. So in our records, we are now showing that every single unit we have, whether it was in beginning inventory or a new purchase, every single unit now has a value of $77.25. Did we actually pay $77.25 for anything we have? No, we either paid $75 or we paid $77.50. We don't care. As far as we're concerned, it's all the same. A 12-ounce box of Kellogg's Corn Flakes is a 12-ounce box of Kellogg's Corn Flakes. We don't care which day we bought it and which day we put it on the shelf. They're all the same. And so we're going to treat them all the same. We're going to use one price for every single unit we have, and we don't have to keep track of which ones are the old ones and which ones are the new ones. I'm not suggesting, if we are a grocery store, that there isn't someone in the aisles making sure. If you've ever worked in a grocery store, you know how this works. When you stock the shelves, you put the newer stuff behind and you pull the older stuff forward to hopefully encourage people to just grab the stuff in front, and you do sell the oldest stuff first. But from an accounting standpoint, it doesn't matter to us. They're all the same price under weighted average, and that's why it's easier, because we don't have to worry about layers. And one of the reasons that companies might like the weighted average is it also removes some of the volatility. So there's a phrase in accounting, not in accounting, that's not what I meant. There's a phrase in finance, in investing. Volatility equals, oops, if I can find the equal sign, volatility equals risk. Volatility means risk. Investors don't like to see risky companies. They don't like to see volatility. So in particular, if you're working in an industry where you see prices going up and down and all around, you might want to smooth out some of that volatility so that your company looks more steady and stable. So think about the types of costs. I mean, we see, if you look around, you see right now, most costs across the board are going up. That's why we're talking about inflation and record inflation. The inflation means the economic definition of inflation, doesn't mean the price of gas went up. It doesn't mean the price of food went up. Inflation means a general increase in the price level. So across the board, prices are increasing. Some prices might go down, but in general, prices overall are increasing for the market basket of goods and services that we would be purchasing. So think about industries where prices tend to go up and then they come down and then they go up and then they come down. The first one that springs to mind for me is gasoline. And if you drive a car and you've seen the price of gas at the gas stations, you know right now it's been going up, and it's been going up dramatically, higher than the rate of inflation. I think I've told you before, in a previous life, I was the cost accountant for the refinery in Bradford when it was Kendall Motor Oil, and we made gasoline, which we sold to United Refining. And that's what stocked the gas stations in this area, the Olean area anyway. And we used a weighted average. We used a 3-month rolling average for the price of our crude oil, because the reason gasoline goes up and down is because the price of crude oil goes up and down. And there's obviously an association there. So we used a 3-month rolling average because it smoothed out those highs and lows and made our pricing look more stable. And we smoothed out that price curve. Yes, the prices generally were going up or going down, but we made it a little smoother by connecting those dots. Let's move on then to our next transaction. On August 9th, we had another sale. We sold 15,000 units. We only have, because we're using the weighted average approach, we only have one price, that's $77.25. Yes, somebody might be in the store trying to make sure that the oldest stuff is pulled front. We rotate the stock, rotate our inventory, and try to sell the oldest stuff first. But in our accounting records, we don't care. We had 20,000 units. We sold 15. We now have 5,000 units left. Oops, sorry. Moving ahead then to October 20th, we now have a purchase. We're going to buy 7,000 units at $80.25. We had 5,000 units. We bought 7,000. We now have 12,000. I'm going to ask you to find the average price yourself. I'm going to find it myself and put it on the screen. But try it on your own first. So I added the $386,250 to the $561,750 that we just purchased. We know we have $948,000 worth of inventory. That is the 5,000 units we started with, plus the 7,000 units we purchased, a total of 12,000. I then took that total cost of $948,000 divided by 12,000 units, and I found $79 even per unit. Again, did we actually pay $79 for any of it? No. As far as we're concerned though, we paid $79 for all of it. And so to find our balances at the end of the month, our total cost in cost of goods sold would be the $6,000 from the first sale plus the $1,158,750 from the second sale. Our ending inventory is 12,000 units at $79 each. Total of $948. Any questions on using the weighted average price? Weighted average method. Okay. So exercise 4 is another practice with weighted average. I've already mentioned exercise 5 and 6 being more practice with FIFO and LIFO under the perpetual inventory. And so, let's see, where are we with time? We have time. Let's go ahead and try another one of these. We'll start with exercise 5 because we have time. We don't need to move ahead to the other work until Monday. We've got time. So with our remaining time, we'll work our way through 5, 6, and then 4 until we run out of time. And whatever we do not get to, if we don't get to all of it, then I will ask you to try that on your own before Monday. So in Monday's class, we'll just answer any questions you might have. But we'll start with exercise. This is exercise 5 and the FIFO method. That's the first one we did today. And maybe what I will have you do is try this on your own. I'm going to pause the recording, give you a few minutes. I'll gauge whether people are done based on what people in the classroom are doing. And I will restart the recording when it seems like people are done. So go ahead and pause the recording if you're watching on the recording. Come back when you've finished this exercise. So looking at our completed inventory record here, we started with 4,000 units at $40, and then we sold 2,500 of those. So we were left with 1,500 at $40. We then made a purchase of 4,500 units at the higher $44 price. And so now we have 2 layers. We have the older $40 ones, and we have the newer $44 ones. On September 2nd, we had another sale of 5,000 units. And because this is FIFO, first in, first out, we are going to sell the oldest ones first, and that would be these, the $40 ones. So we sell all of those, but we don't have 5,000 of those. So we sell the 1,500 we have, and then we sell another 3,500 to get up to the 5,000 total. Those 3,500 had a price of $44. And then of this 4,500 we had at $44, we have just 1,000 left. 1,000 at $44, a total of $44,000 for the inventory. We make another purchase in November. We now have 2 layers, the $44 and the $46 one. So we're in a period of rising prices. The final line is for the end of the year balances. So we have our total cost of goods sold. Remember, that might need to be adjusted for shrinkage, because at this point we're assuming in our ending inventory we have all 3,000 cases or units, whatever this is. We have all 3,000 units left, and it might be when we do our physical inventory we discover we only have 2,978 or something like that. So we would have to make an adjustment for those missing 22 units in my example. And those would come also from the oldest units. Even inventory shrinkage, we assume the shrinkage came from the older units, the $44 ones. Okay, anyone with questions on that? So I think with the time we have left, we can, based on how long it took us to do exercise 5, we can probably get through exercise 6 as well. So this is same information we just had, but now we're using the LIFO method. So again, we'll be able to do that comparison like we did in exercises 1 and 2. Perpetual inventory system, LIFO method, and I'm going to go ahead and pause the recording to allow you to try this one on your own. And once you have finished this exercise, please restart your recording. Okay, so at this point, you should have completed exercise 6 and your chart hopefully looks just like mine. So this is using the LIFO method. We start with that same inventory. The original purchase comes from that $40 inventory. That's all we had. The, excuse me, I think I said purchase, I meant sale. The sale came from that 4,000 inventory, $40 that we had. Then we make a purchase and add that extra layer. When we make our sale on September 2nd, we have 2 layers of inventory, the newest stuff at 44 and the oldest stuff at 40. Because we're using LIFO, we sell the $44 ones first. So we sell all of those, and that's not quite enough for our 5,000 sale. So we must have sold 500 of the lower LIFO layout, the $40 stuff as well. And so what we're left with is 1,000 units of the older $40 stuff. We make one more purchase at the end of the year and add that second layer here. And so our ending cost of goods sold is the total of the three amounts here in the sale column. And our ending inventory is the 132,000 total of the 2 layers. If we compare that back to what we had in the previous exercise, you'll notice under FIFO, remember we're in a period of rising prices here. The prices went from 40 to 44 to 46. So in a period of rising prices, FIFO has a lower cost of goods sold, 314 compared to 318. And LIFO has a lower ending inventory, 132 compared to 136. You'll notice it's off by, they're different by 4,000. So, and that's true for cost of goods sold and for the ending inventory. I need to point out though, we make one assumption in these exercises that really doesn't make sense in the real scheme of things. The assumption that we've made here in these 2 exercises is that, and in exercises 1 and 2 where we did the same thing, the assumption we made is that the beginning inventory was the same, in this case 4,000 units at $40. We said the beginning inventory was the same under LIFO as FIFO. So where does that beginning inventory come from? It's the ending inventory from the previous period. Well, we just saw that the ending inventory here under FIFO was 136. And what did I just do? There it is. I have no idea why it jumped me to the end. And here under LIFO, it was 132. So if the ending inventory December 31st is different, then the beginning inventories January 1st would also be different. So we've made that assumption for this exercise that the beginning inventory was the same so that we could compare. What does it look like at the end? So that we compared from the same starting point. But what I want you to realize is the longer these companies go on doing exactly the same thing, but one using FIFO and one using LIFO, the farther apart those results are going to be. Okay, so here we've got a $4,000 swing. We made the assumption they started at the same point. In reality, they wouldn't start at the same point. In reality, LIFO's inventory in a period of rising prices would be lower than the company doing exactly the same thing but using FIFO. $4,000 for this company as a percentage is not a real big swing. But the longer these companies go on doing the same thing but reporting it differently, the more pronounced a difference you will see between those results. Okay, so we are almost out of time. We don't have time to do exercise 4 together, but I do want you to notice that exercise 4 is the same information that what we just did in 5 and 6, but this is for weighted average. So you already know, as you're working on this, that your results for exercise 4 are going to be somewhere between the results for 5 and 6, because this is the middle ground, the average. So I would like you to try this on your own. As always, you have that check my work. You can check yourself. When we come in to our next class on Monday, I think what I'll do is I'll just put the information in here so we can go through it quickly together on Monday and answer any questions that you might have. All right. Any questions? Anything? All right, we'll call it a day. So thank you for being here. I hope you can enjoy the sunshine. For those of you who are observing Lent and Ash Wednesday today, I hope you have a blessed day. Hope you all have a blessed day, but in particular, people who might be observing that religious holiday. See you all on Monday.